What's up, everybody, and welcome to the Benefit Breakdown, your go-to channel for everything employee benefits related. My name is Brandon Huerta, and today we're going to be covering the fascinating subject of the taxation of benefits.
Boring!
But in all seriousness, this is very important that you get this right so you don't have the IRS knocking on your front door. This video is relevant for everybody, but more specifically focused for payroll and HR professionals. Without further ado, let's break it down.
One way or another, I'm gonna find you. I'm gonna get you one way or another.
Before we talk about the taxation of each specific benefit, it's really important that you understand two general concepts. One, what does pre-tax mean? And two, what does post-tax mean? Now we're going to cover a Section 125 premium only plan in a separate video, but for all intents and purposes and to keep things simple, pre-tax means that your payroll deductions are taken out of your gross pay before taxes are applied. In other words, it lowers your taxable income, which means you save money in taxes, which is a really good thing. While pre-tax benefits are great, the IRS places restrictions on most of them. For example, if you enroll on a pre-tax benefit, say medical insurance, during your open enrollment, you are stuck on that particular plan and you can't make changes or drop coverage unless you have a qualifying life event. Otherwise, you're stuck on that particular plan until next year's open enrollment. Conversely, post-tax payroll deductions for employee benefits do not lower your taxable income and therefore do not save you money in taxes on the front end. Well, you might ask, why the heck would I want a post-tax benefit if it's not going to save me money up front? The reason is because it's going to save you money on the back end at the time of your claim, and that could be rather substantial in the case of life insurance. Also, post-tax benefits allow you to terminate coverage at any point during the year. You don't have to wait until open enrollment. All right, let's get into each specific employee benefit and their particular taxation. First up, we have medical, dental, and vision. They're always pre-tax, except there's a caveat for domestic partners. The IRS does not have favorable rules, so an employer contribution that is allocated towards your domestic partner is going to be considered an imputed income and a tax to the employee. Now, the payroll deduction that an employee pays that's allocated towards the domestic partner is going to be done on a post-tax basis. If this is confusing to you, don't worry, I'm going to shoot a separate video that goes to the details of this particular calculation. Health savings accounts or HSA contributions. Employer contributions are always going to be pre-tax, and employee contributions are going to be pre-tax as well. But it's important to know that employees can change their contributions at any point throughout the year. And also, you want to make sure as an HR or payroll professional that you allow your employees to contribute through payroll, because not only is it going to save them on income taxes, it's going to save them on payroll taxes. And if they're paying less in payroll taxes, then you, the employer, your 7.65% of FICA and Medicare taxes that you match employees, that's going to be reduced as well. Flexible spending accounts, or FSAs, and your dependent care assistance program, also sometimes referred to as a dependent care FSA, are pre-tax up to the IRS limits. You have commuter benefits, your parking and transit benefits. Those are done on a pre-tax basis. However, this is governed under Section 132F, not Section 125, so you can change your elections for commuter benefits anytime during the year. Employer-paid life insurance, or basic life and AD&D coverage. The magic number for tax rules is $50,000. An employer can cover $50,000 for their employees with no tax impact to the individual. Now, if you pay for more than $50,000 worth of coverage for your employees, whether it's a one-time or a two-time salary, or maybe it's just a flat $100,000 benefit, the amount in excess over $50,000 is taxable as an imputed income to your employees. Now, this can be a little bit confusing, so I'm going to shoot a separate video that goes through that specific calculation. Voluntary life insurance, or employee-paid life insurance coverage or supplemental coverage, this is always going to be post-tax. And the reason it's post-tax is because you want to make sure that the benefit to your beneficiaries on the back end is tax-free. Super, super important. You don't want to deduct this pre-tax up front, because then the benefit would be taxable on the back end. Not going to be a good situation. You have to pay hundreds of dollars in taxes potentially. So remember, voluntary life insurance, post-tax on the front, so it's tax-free on the back. Short and long-term disability insurance coverage. This one trips up a lot of HR and payroll folks because it can be either pre-tax or post-tax, depending on how the benefit is set up with the insurance company and how it's managed through payroll. Now, most of the time, employer-paid coverage is done on a pre-tax basis where the company pays a premium to the insurance company and doesn't pass through any taxes to the employee. That means at the time of claim, of disability claim for the employee, they would pay taxes on their benefit. Now, you don't have to set it up that way. You could set it up as a gross up or a bonus up program where employees pay taxes on the front end to therefore receive a tax-free benefit at the time of claim. Now, for voluntary coverages for disability, you typically will set this up as post-tax so that employees have a tax-free benefit on the back end. Now, if I lost you there, don't worry. A lot of people get tripped up on the taxation of disability benefits. So don't worry, we're going to create a separate video that dives into those details. Next up, worksite benefits. These are your AFLAC type coverages. So your hospital, your accident, your critical illness type coverages. We almost always recommend that you set these up as a post-tax benefit so the benefit received on the back end would be tax-free. So if I have a $50,000 lump sum critical illness policy, that if I'm diagnosed with a critical illness, I'm gonna need all the money possible if I'm diagnosed with that critical illness. We set it up post-tax so that benefit is tax-free on the back end, so I would get that full $50,000 and not net of taxes. Pet insurance. This is going to be a post-tax benefit. Unfortunately, the IRS does not provide preferential tax treatment for our furry little friends, so you can't do this as a pre-tax benefit. Has to be post-tax, unfortunately. The IRS needs to change that. Next up, we have tuition reimbursements. Those are pre-tax up to a certain limit. You also have gym reimbursements. Those are going to be post-tax. The IRS does not allow the pre-tax treatment there as well. Then lastly, we have our 401k contributions. Our traditional 401k are going to be pre-tax, and our Roth contributions are going to be post-tax. As an HR or payroll professional, it's critical that you get the taxation of employee benefits right. So that way you're payroll deducting employees properly, employees are being taxed or not taxed properly at the time of claim, and also we want to keep the IRS from knocking on your door. All right, that's it for the benefit breakdown. If you like this video, please hit that subscribe button and share it with your HR and payroll friends. See you next time.
Get you one way or another. I'm gonna win